Okay, I think you have the questions too on your end,
I
Andrea. So
do.
as you go into the screen share, I'll get myself together and I'll ask you questions, and of course the audience can as well. So why don't you take the screen share from me here?
Yeah. So the
Thank
first
you.
question, yeah, no problem. So the first question that Andy and I came up with, let me pull up I'm going to share my screen right now. It's going to be looking at, you should be seeing a QuickBooks Online screen. Not that you would necessarily know what that looks like if you're never in it. Okay. So the first question that we came up with, a common problem that we see is partnerships that are converting to S corporations, right? It's just like you run into the same issues that you run into when like a regular LLC, a disregarded entity LLC converts to S Corp. Same issues happen with partnerships. So there are a couple of ways you can handle it. And we're going to be looking at this from the accounting side. Talking about the tax side of it is a whole other topic. So partnership in 1 year, S corporation in the next year. How does that change the QuickBooks Online file? So what we're looking at here in my QuickBooks account is the chart of accounts. And for those of you who are unfamiliar, the chart of accounts is just a listing of the different account codes that expenses and income can be posted to. And so I just entered some very basic opening entries. So for this partnership, it's a 2-partner partnership. They're 50-50 owners. Partner A is Andrea, partner B is Andy. At 12/31/21, they had $10,000 in the bank and their only assets were 2 laptops. I told you we're keeping this super simple. So these laptops had an original cost of $2,500. They were purchased on January 1st of 2021. So they've had 1 year of depreciation recorded. So $500, 2,500 divided by whatever, $500 is just what I recorded. So their S election was effective January 1st of 2022. So what do we need to do in the books to reflect the changeover from a partnership to an S corporation? And I'm going to preface all this by saying, this is how I handle this. If you ask 10 accountants, you could get 10 different answers. This is just the way I like to do it. It's not necessarily US GAAP accounting. The majority of my clients are small, privately held businesses, so they're not required to follow GAAP. So we don't always make sure that their books are GAAP. So in this case, 12/31/21, they still had $10,000 in the bank, and they had assets with a current book value of $2,000, right? It was $2,500 minus $500 in accumulated depreciation. Each laptop is worth $2,000. So I like to move all of the assets and the cash through the process as if they closed their partnership and reopened as an S corporation. So you don't have to create a whole new set of books. It's the same EIN, it's the same business name, it's the same partners, now members. But I still like to move the transactions through the process to make a clear separation. Now, ideally, you'll know when you're doing the 2021 tax return that they're converting to S corporation in 2022, because you can close everything out on the partnership return and then start the S corp with all the correct balances. But let's be real here. We don't always know that. Sometimes they don't make the decision to elect S corporation until September of the following year or whatever. In this case, they knew at the end of 21 that they were going to be an S corp at 2022. So what we essentially need to do is distribute the $10,000 sitting in the bank, and we need to distribute the assets at book value, because they're really, when you essentially close the partnership, they pull all the assets out, they distribute it to themselves. And then when the S corporation opens, they're contributing those assets and that cash to the S corp. So the first thing we're going to do is an entry in QuickBooks to close out the assets. So I'm going to create a journal entry at 12/31/21 when the partnership ended. The checking account had $10,000. We're going to remove all that. That's out. And we're going to distribute it to each partner. So we've got $5,000 going to Andy. And we've got $5,000 going to Andrea. And I'm going to close this journal entry so we can go back to the chart of accounts. And now you'll see the bank account has 0, right? Bank account's closed out. I'm not sure how many of you are familiar with how to close out assets in the books, but we're going to close them out at book value, right? They've taken $500 of depreciation on the partner return. So the adjusted book value now is $2,000 per laptop. That value doesn't change just because the company converted to an S corporation. But I want to have entries in the register for each laptop to show partnership closed, S Corp started. So the first thing that you have to do when you're clearing assets off the books is you have to close them out at their original cost. So I'm going to essentially sell laptop 1 from its original cost. And when you add an asset, it's a debit. When you remove an asset, it's a credit. So I'm closing it out at its original cost. And I'm closing out its accumulated depreciation, right? Because we need to zero out that whole laptop as if it was sold to an uninterested third party. So we're going to get rid of both laptops. Okay. I'm going to stop here. Well, I can't stop here because we're not done with the journal entry. So what is the other side, right? Each laptop has a book value of $2,000 now. So we're going to just distribute that to each partner distribution to Andy for $2,000. And then we're going to distribute my laptop to me for its book value of $2,000. And now when we go back to the chart of accounts, you'll see that the laptops now have value of 0. It's as if I sold them to somebody and they're no longer owned by the company. Everyone with me so far? I can't see everybody's faces. Let me see if I can tile this and make this a little bigger. So don't hesitate to shout out if I'm going too fast or if you need me to go back over something.
Yeah, I think this is great. I actually have a client that I'm working on today that that moved from a partnership to a C corporation. So this is actually super applicable. So can you talk for a second about the impact on the tax return, right? So that's the accounting part of it, where you're getting all the assets to 0, you're contributing them into a new corporation, but there's distributions to the partners from those assets being kind of, I guess, removed out of the partnership or the partnership closing down. So how do you see that affecting the tax return?
So that is where whether you know that it's converting to an S Corp or not really has a lot of weight. I think, and I'm not exactly sure of the correct answer, maybe one of you can weigh in. Do you have to mark the final partnership, like the final year that it's taxed as a partnership? Do you have to mark that return as final? I've seen discussions about this in the accounting community, and some people say yes and some people say no. So if you are in the camp where you're supposed to mark the last year that it's a partnership as a final return, you really need to know that it's the final year, right? If you've already done the tax return, March 15th, and they don't elect S Corporation until September, but backdate it to January, then that partnership return is already done. I'm kind of the opinion at that point that you let sleeping dogs lie, pick it up as an S Corp and not really worry about moving the assets on the return through the process. It would just be more notes in your work papers. So it's really a timing question.
Yeah, totally. I would say for me, I would not mark it final if it's the same EIN, because it's still a, and Tosin saying the same thing. Yeah. That's my thought. But yeah, you bring up a good point. Like this situation that we have, it was a partnership and now it's a C corporation. So it's actually a totally different EIN. It's a totally, but like these let's say, Andrea, what you just wrote into QBO, right? Involves, distributions and involves things that are affecting the partner capital account. So like on the tax return for this partnership, then you're like recording the distribution of the book value of the computer, for example. Like that's going on as a distribution to that partner.
Yep.
Okay.
Correct. And then on the book side, after I clear out the assets, then I would make another journal entry as of 1/1/22, which is day 1 of the S Corporation. So I'm going to put the money back in the checking account.
Gotcha.
$10,000. Trying to short them $9,000. And now it's a contribution from the member. And this is essentially setting up the member's equity account in the S Corporation now. So if I enter that and I save and close it, now we come back here and you see the 10,000 is back in the checking account. If we look at the register, it looks a little bit wonky. Ignore that first entry. That was just me creating balances for us to play with. But I made the journal entry to distribute the 10,000, and then I just turned around and immediately recontributed it. It's the same $10,000. We didn't actually pull it out of the bank account. So when you go to reconcile the bank statement, you're going to have to just check these off, even though they don't actually appear on the bank statement. But it helps to create a nice, clear, and I would normally include a memo, right? On the closing entry, I would say closing out, partner capital accounts or whatever. And on the opening entry for the S Corp, I would put creating S Corporation membership equity or member equity accounts or whatever. I would have detailed notes so that 10 years from now, I can remember what I was thinking when I did this. Accounting rules could have changed by then, and I could be looking back and thinking, man, this chick was crazy.